Hey everyone, Douglas here, and welcome back to the channel. It's market recap time, Tuesday, September 5th, 2023. We're going to go ahead and get right on into things because I think it is finally time. It is finally time for the bears to have their shot. Some things are brewing, some things are developing in markets, really at the most important level where I think we might finally see a roadblock for the rally that really we've seen for the majority of this year to finally hit a roadblock, finally hit a bit of a headwind here. I think markets are going to be due for a bit of a choppy time over the coming months. That's what we're going to discuss tonight. I'm going to make the at least short-term bear case that I think September and October might get a little dicey here and could get if things really play out quite poorly. Things could get very, very dicey, and selling could really take hold over the next few months. But I want to make it clear that I do think this would be a relatively, in the grand scheme of things, short-term sell-off. And I do think by the end of the year, we will start to see markets reaccelerate into some higher highs and possibly even target the all-time high that we set at the end of 2021. All right. Let's dive into things tonight. What I've got up on the screen, and we'll dive into this in just a little bit more detail, is the monthly comparable, the fiscal flow monthly comparable. Look, MMT 101, when the government spends, that becomes net financial assets for the private sector. When it taxes more than it spends, that's removing net financial assets from the private sector. That is, again, MMT 101. If you're going to invest on those principles, generally speaking, what you want to look for is large fiscal flows that will propel markets. And that's why at the end of 2022, while everyone was calling for a recession, using an applied MMT approach, it was very obvious to me that we were not headed for a recession, but instead we were headed for a major market rally. On Twitter, I made that case at the end of 2022. If you're not following me on Twitter, make sure you follow me on Twitter. I will oftentimes spell out these threads there as well. But that's the case at the end of 2022, that we would see a massive rally heading into 2023 because of the additional interest income that the government was going to have to pay because of those higher interest rates, right? The Fed has the interest rate thing backwards. We've gone over this many times, and that's exactly how it played out. So if those fiscal flows are what helped drive these markets so much higher through 2023, it makes sense that if we're going to hit a bit of a ceiling on those flows, that we might end up seeing a bit of a pause here for markets. And I think that's exactly what's going to play out. What I've done is I've brought the monthly comparable table here that is always available over on the MMT Macro Trader dashboard on the MMT Macro Trader Patreon, link in the description below. But I've got the monthly comparable fiscal flow table, and this comes right from the daily treasury statement. And what you can see is, going back to the pre-COVID era, we had a pretty predictable, quite predictable pattern of how the tax season and the flow season played out. Always started off with a small tax at the beginning of the year, large tax drain in April, obviously tax season September. Let's look at 2018 here, for example, September. Oftentimes a bit of a tax drain from the corporate side, and then again the end of the year tax drain that, or beginning of next year tax drain that plays out to finish off the year. And then you can see the big surge in fiscal spending from May through August, the October through November surge, just kind of the normal cyclical pattern that generally plays out. Obviously, COVID changed all of that. We've been seeing this big bullwhip effect play out. Massive stimulus offsetting deferrals of tax payments led to the massive tax drain, the largest tax drain in history that we saw in April of 2022, which really put us into kind of the bear market and kept us in the bear market for 2022. But it was that massive fiscal stimulus that we saw at the beginning of, really starting at the end of last year into the beginning of this year, that really allowed markets to take off. And then during the summer months, we've seen just again massive fiscal stimulus from the additional interest income that has helped keep these markets pushing higher. But September is going to be a likely large drain, because we're just kind of back into the historical cycle. So we will see a tax drain in September. In and of itself, if it was just the tax drain in September, I wouldn't be terribly concerned. But there are a couple other things happening right now that are a bit concerning, that could compound kind of the already brittleness of the kind of core flow here, giving way for markets. The next thing that's going to happen, we're going to have the September tax drain. The next thing that's going to happen is the October flows might not end up being there. The reason for that is there was a tax deferral allowed for multiple counties in California because of a major natural disaster that occurred last year. If your county was affected by that and your corporation was in that county, you've been allowed to defer taxes ultimately to October 16th of this year. As it turns out, the counties in Silicon Valley or Silicon Valley is in the counties that this applies to. So a lot of the big names, Google, Meta, have not paid corporate taxes this year. And it's my understanding, I think it was Google or Meta I saw on their balance sheet that they have something like $10 billion in unpaid taxes that are going to hit. So if we go back to this table and we look at, let's just say October of 2018, that was a net flow of almost $100 billion. If we jump forward to October of 2019, again, just a little over $100 billion. Let's see, October of 2017, $50 billion. So if multiple companies have multiple billions that they're going to have to send into the IRS, the big surge in spending, particularly the big surge in spending that takes place after the fiscal year kicks off, there's a lot of spending that kicks off early in the year, is going to be offset by these taxes that just haven't been paid yet. So we're going to see a likely drain in September, and then a probably drain, if not flat, October. And so the flows that would normally kind of kick things right back up into the end of the year are just not going to be there. So we're going to see a back-to-back kind of double whammy here for those fiscal flows. So look, markets are very strong. I think we're going to start to see the bank flows really start to come online again. Maybe this turns out to be nothing much. Maybe we just chop sideways. Maybe we push back down to say 4,300 ultimately before we push higher in some sort of kind of consolidation consolidation move. But there are other risks that are taking place where, at least for me, moving to cash during this time period just has made the most amount of sense. Number one, and this already started up in August, but we'll go ahead and take a look at that, and that is that payments for the student loans have started back up again. And for the most part, we're pretty much back online in full force. This is 2019. I'm showing the daily treasury statement for the payments back to the Department of Education. And you can see that for the month of August of 2019, we ended up at about $6 billion. And if we fast forward now to the end of August for this year, just above $6 billion. Now, if you look at the fiscal year to date, we're nowhere near where we were at this time in 2019 before the pause took place for COVID. But we're going to start getting there, right? I mean, for the most part, they're just starting back up. People are paying. Now, in and of itself, this is not a long-term detriment, right? I don't really see this being a massive macro shakeup. On the micro level, obviously, it's going to suck for those who this is going to affect. That's a whole different story. But on the macro level, I don't see a ton of impact from the resumption of the student debt loan payments. However, on the very short run here, it's just going to add to a flow that, or really a subtraction of a flow, a drain that just wasn't been there and hasn't been there. And it's going to compound the drain that we're already likely going to expect or are anticipating for September and October. So we're going to see this drain happen in September and October on top of the tax drain that we're already going to see and on top of the additional taxes that we're going to see in October. So again, some compounding events here. The flows are just really going to falter here as we head into September and October. And to that, the fact that we've just been on one hell of a run to this point. Things are just adding up for a bit of a pause. But there is one more risk. And to me, this is really absolutely the biggest risk that could take place. And that is the fact that we're at the end of the fiscal year and we have to get an agreement in Congress to pass a budget or the government will shut down. Now, I've done some research and it looks like immediately after a shutdown, we won't stop payments to the private sector immediately, right? So those flows are going to continue. Maybe a few of them get shut off, but the main ones, Social Security, healthcare, Medicare, Medicaid, those flows will continue to flow out. However, just the fact that the government has the potential to shut down will certainly add fear. And if it looks like it's going to be quite the impasse and the shutdown could last for a while, that could eventually impact flows. And even if it never does, just the potential risk of that and the fear would reverberate through markets. You'd get a ton of hedging activity. That hedging activity is a bit of a self-fulfilled prophecy, and you would likely see some major selling take place because of that in an already brittle market environment where you are getting tax drains. As it turns out, even if the government shuts down, taxes are still due, so the tax drain would still happen. It wouldn't pause that. I think you get the point. You could end up seeing a real fear-based event take hold of markets and really kind of kick selling off until that got settled. So the downside risk here is quite large. The likelihood that at the very least we move sideways, maybe pull back 5%, 6%, is quite high at this point. So to me, I think it's finally time where to allow the bears to have their shot here and see what they can make of the next 2 months. Like I said, I'm back on the sidelines, and we'll wait for a better buying opportunity. We'll wait for those flows to start to kick in as we really tread through what will be a few months of overall kind of softness in flows and the potential for markets to really get red here for a few months. So that is why I think the Bears have their shot here in the argument for tonight. That's all I got, though, for tonight's update. As always, if you like what I'm doing here, make sure you get subscribed, hit that notification bell so you won't miss any updates going further, and then head on over to the Patreon page, patreon.com/MMT Macro Trader. You get updates just like this one in much more detail, data-driven, multiple times each week. We have lots of data, lots of models to go over this data that really help us wrap our minds around where markets are headed next and build some compelling, actionable decisions based on that data. All right, that's it for the plug. I'm going to go ahead and wrap things up here. Until next time, good trading, everyone, and we'll talk to you then. Bye-bye.